Hi, JJ here with The Art of Value. Welcome. Today we're going to look at legendary investor Chuck Akre, who's had multiple 100-bagger investments over time and many multi-baggers. We'll look at his portfolio and his investment strategy, which is called the three-legged stool. He likes simplicity, which is good for us, and we'll look at his approach and what he says about it. It's from an interview from 2019, which I listened to, a great podcast interview of an hour. I'm going to summarize it, discuss it, see what he said about how to get these multi-baggers over time. So let's get into it. First, for context, let's look at the companies Akre Capital Management owns. Let's look at their portfolio, see what they've got in there. We know he's into quality compounders. At the top of the list there, which they've owned for a long time, he talks about this later on. Mastercard, which makes up over 16% of the portfolio. And then Moody's, American Tower. American Tower's been a 100-bagger for him. Constellation Software, another well-known Canadian stock with Mark Leonard. I've talked about Constellation Software before. And Visa, so Visa and Mastercard both in there. O'Reilly Automotive, which he talks about later on. KKR, Roper Technologies, Brookfield Corp. My last video was about the CEO of Brookfield, what he's saying right now. I'll put a link to that in the description as well. CoStar Group, Adobe, Danaher, Topicus, which I'm a shareholder of as a small cap, and CarMax, Brookfield Asset Management, Digital Bridge Group, which I've been looking into lately, Goosehead Insurance, Berkshire Hathaway, Dollar Tree, and Verisk Analytics there at the bottom of the list. It's 20 companies they own altogether. They've owned some of those for a long time. They've had huge wins out of those ones, and some not so long. So let's get into what Chuck Akre has to say about his investment strategy, his approach to investing. Notably, or somewhat famously, Akre lives in a one traffic light town, Middleburg, Virginia. He has for a long time. He's worked there, has an office there, and the reason for that is he says there are no distractions. Say if he lived in New York, there'd be too many distractions from his investing friends and the excitement of the market. So it's really good for research and just a calming place to really think things through. And funnily enough, a lot of value investors say this, who don't live in New York. A lot of them, they live in other places, and Warren Buffett being the most famous, living in Omaha, but there are other ones around the world who live away from the financial centers where they can think and there's no distractions, no noise from the markets. So this interview was from 2019, as I said, so it's a few years ago. I think he's retired since then, the word is. I don't know if that's completely true, how retired he actually is. Manish Pepperai said he went to visit him in this one traffic light town a while ago to see the one traffic light and to talk to him about the three-legged stool of investing. On his investment approach, he said that when he was working full-time, they would spend all day talking through ideas and reading, which is also common to a lot of great investors, just reading all the time. Charlie Munger reads a lot. Warren Buffett reads a lot. A lot of the investors just read all day, if they can, about investment research and investment books, constant learning and research. He says that fundamentally their investment approach is non-quantitative, so more qualitative. It's not all about the numbers, and we'll see how that plays out in the way that they go about looking for companies to invest in. He says that in investing, imagination is more important than knowledge. So you can be very bright but still not be a great investor. So he says imagination and curiosity and creativity are the things needed for investing. He says the search process is very important, and those things are important in the search process to find the exceptional businesses. He was asked about the origins of his three-legged stool idea, the famous three-legged stool, his approach to investing. And he has three-legged stools actually in the office, he says. He's got 4 of them. He says it's a visual construct and it's right there in front of them to remind them of what makes a great business and how to find it. So the first leg of the three-legged stool is finding an exceptional business with high ROE, return on equity. He said that the return on the asset will always approximate the ROE in the end, and that's something that Charlie Munger has also pointed out in the past. He also says that they aim for a modest starting point valuation, a market valuation when they buy, for that margin of safety, which value investors talk about too. You always want to buy lower than the intrinsic value if you can. Put simply, he says, to have above average outcomes, you have to have above average returns. And to do that, you look for businesses with this high return on capital, high return on equity for the business. So that's the first leg of the stool, is to find businesses that have this high return on owner's capital for a long time, not just for a short time, but sustained over the long term. He says when they find businesses like that, they try and spend a long time trying to figure out why, what's causing that in the business. And they look at what the runway ahead looks like for the business. Are they going to still have the ability to earn these high returns on capital for years and years ahead? The second leg of the stool is to look at the people running the business, the people who have achieved this high return on capital. Can they do that in the future? What's caused them to do that? Are they capable of doing this in the future? So it's the quality and the integrity of the people who run the business. And also, do they treat shareholders like partners even though they don't know us? That's important to him. So that's shareholder friendliness. A lot of investors look for that, and he does too. He thinks it's one of the legs of the stool is the integrity and that they're treating us like partners, people who invest in the business. And the third leg is their record of reinvestment and the opportunity in the future, their runway for reinvestment. Are they able to reinvest at a higher rate of return in the future? If you're getting value out of this episode so far, I'd appreciate it if you like to help spread it to more people, help with visibility. Also, we're well over 1,000 subscribers now on YouTube and Spotify across those video podcasting platforms. So if you're not subscribed yet, perhaps if you are enjoying this episode, think about subscribing so you can get this kind of content and more episodes. And he mentions that once all these things are in place and they're sure, they're still not willing to pay very much for the business. So that margin of safety, which can be difficult with a high quality business that's compounding to get it at under a price. Sometimes it happens. We've seen even in the last few years that good quality business can go down 50% at times. So they're just willing to wait and patient and not willing to spend a lot on that business, not pay up for it. And speaking of share prices going down a lot, 30 to 50% or more, he says one of the hardest things to do when you own a business, a great business, is not to sell it because unexpected things happen, but the business fundamentally hasn't changed. It's truly one of the most difficult things in investing, he says, is to hold on to it, not to sell. He says they generally don't talk about the companies in their portfolio and certainly not the companies that they're buying and selling at the time for obvious reasons. Either it's coming in or going out. They don't talk about it when they're selling or buying. Having said that, he did talk about a few of the companies in the portfolio and their decisions to buy and sell and how they came to that decision, which is great for us. He does talk about Mastercard, which is the biggest position in their portfolio at over $2 billion and over 16% of the portfolio now. He said that they started buying it in March 2010 when it was trading at 10 or 11 times earnings. What he discovered about Mastercard at the time is that their margins and returns on capital were incredible. In fact, he said, and let me get this right because I want to get the exact quote, he said, "There's not a word in the English language that's superlative enough to talk about them. You could cut the margins of them in half twice and you'd still be above average for an American business." So clearly something extraordinary is going on here. And here I'll just put the stock chart of Mastercard on the screen if you're watching on video, on Spotify, on YouTube. It's had a gain of over 1,400% since that time that he mentioned that he bought it in March 2010. 1,400% since then, so it's been a big winner for them. When they found this out about Mastercard, he said that he asked, what does that tell you? And the first thing he said was that they've got a target on their back. When they have margins and returns on capital like that, everybody wants a piece. There'll be competitors trying to come in and take some of that. In fact, he said they're probably jamming every expense they can into their income statement to try and hide how good their margin is. He said they're trying to figure out what's causing that, why the great margins and returns on capital. And he said, we think we've worked it out, but we're not saying, we're not going to tell you. And the company certainly doesn't talk about it. Not one of the legs of the three-legged stool, but still one of his important investment ideas is everything should be made as simple as possible, but no simpler. They've got a sign up in the office that says that. With the idea of making things as simple as possible, he said they always look at everything from a top-down basis. In terms of the FANGs, he said, as an example, they always look at that in terms of distribution. He says that those are all about changes in distribution of all kinds. He gives Amazon as an example, saying that that was about distribution of books and then everything, and then their cloud services, distribution of information. So he boils that down as simple as possible to distribution and the changes of distribution that happened with the internet. He says that's looking at it in a simple way to look at the context to see what's going on. He says we're always at risk of getting too much into the weeds and not seeing the bigger picture, the simpler picture of what's actually going on. Going back to the second leg of the stool, he was asked about the characteristics of the people involved, what he looks for, and he says one of the things is that the CEO and the management doesn't have a screen of their stock ticker of their company in the foyer or on their desk or anywhere. It's not something that they care about. It's not high on the list. He says he always asks the CEO, how do you measure whether you've been a success in running the business? How do you measure that? And he says it's pretty rare when a CEO comes back and says that the main thing is compounding the intrinsic value of the company, compounding the economic value per share. He says that's pretty rare for a management or a CEO to actually say that. And that's because he says most CEOs aren't trained to think that way. That's not how they think. It's not important to them. And I think that's one of the reasons it's good to look for founders, people who started the company, CEO founders. If you look at some of the greatest businesses of all time, they've been founders. They've been built it up from scratch. They realize the value of the company. They've built the value up. They have skin in the game. They own a big chunk of the company. So they do think like shareholders. They think like owners of the company. And a big part of this, he says, is about capital allocation, looking for good capital allocators. And the owners of the business, the people that think like owners, think about the value of the company, increasing it, compounding it over time. That's about capital allocation. So he says this is really important, looking for good capital allocators. And this is where he brings up O'Reilly Automotive, which is another company that they own. And if you look at their stock graph, you can kind of tell that they've been good at capital allocation, good at reinvestment, just from the long run that they've had over time. He says that they've been good capital allocators, buying back shares at cheap prices. That's one of the signs, but in other ways too. So he's picked another good stock there by the look of it. Definitely that's been a great compounder over time. And it's when he's talking about capital allocation like this, he starts talking about Thomas Phelps's book, 100 to 1 in the Stock Market, which I've read. It's a great book. I read it after 100 Baggers, which is a book by Chris Mayer, who read the Thomas Phelps's book and wanted to update it for modern times because it was back in the 1970s, I think, that Thomas Phelps wrote it. But they're both really worth reading. They're some of the best investment books that I've read, and I'm going to put them in the description for a link to those books. What Chuck Akre says about Thomas Phelps's book is that that was the book that to this day remains inspirational to me, fundamental to me in terms of thinking about the issue of compound returns. He said that Phelps didn't explicitly talk about compounding that much, but he did talk about 350 public companies that you could have bought as an investment and had 100 times returns on your money. So obviously this is important to him, and he has had 100 baggers. Chuck Akre has had several hundred baggers in his portfolio over time, so it's really fascinating to me that he liked this book, and I think he'd probably like 100 baggers. I don't know if anybody's ever asked him about that, but it's an updated version. Honestly, it's one of the best investment books I've ever read. And I feel the same way as Chuck Akre about having read it. He says the important inference in this book is that the rate of compounding of these companies, that's the big difference between those companies investing in those, investing in others, is the rate of return. And that's what struck him when he read it. And that's what he's been looking for all this time. So he says he looks for those companies that make a lot of money, but also reinvest it at a high rate of return for a long period of time. He mentions Visa and Mastercard here. He says that these companies have so much money to reinvest that they can't actually reinvest it all. They do dividends and they do buybacks to reinvest in themselves, but it's best to reinvest in another way if you can, but they have so much money they don't know what to do with it. This is when he starts talking about American Tower, which has been 100 bagger for him, which he explains, and it's that reinvestment story that's been a big success, just straight from Thomas Phelps, really, that 100 bagger that he has and how it happened. He said they have 55,000 towers around the world. Each tower is its own asset, and he compares it to Microsoft in the days of the personal computer. If you wanted a personal computer, you basically got Microsoft along with it. It was like a toll booth on a personal computer. If you got a personal computer, you got Microsoft operating system with it, so that became a monopoly. And he said that American Tower is similar because it's the infrastructure that makes the connectivity, so it all has to go through towers. It's like a toll booth on the growth of digital communication, and every generation of wireless communication needs denser and denser networks as well, so it just compounds on itself as well over time. He explains about when they first bought American Tower. He said that it was during the dot-com bubble, well, after the dot-com bubble, and it went to $60, the stock price, and it crashed down to lower than 79 cents into the 60s. He said they first bought some at 79 cents, and as you can see from the stock graph, it's well over 100 baggers since then, so it's one of the most amazing investments that you probably ever see. We can see on screen there from that price, it became a 100 bagger in 2013 and went on from there. In fact, it's had over 25,000% gain since then, which is pretty incredible over that time. It was just a small company back then in the hundreds of millions, and now in the tens of billions, and that is the kind of investment that anybody would want, right? What he said next was interesting. He said that you only need one or two in your career, even one in your career, to do very, very well. And this is something that Monish Pabrai has picked up on recently from Chuck Akre, in fact. Monish has been talking about this in his Circle the Wagons talk recently, which I made a video about. He talks about Chuck Akre, the three-legged stool, and the forgiving nature of investing, where you can make a lot of mistakes and still do very well, especially if you get a 100-bagger along the way. He talks about the small cap nature of American Tower and other companies that they've bought, because if you want it to grow 100x, it's best if it starts small. He talks about it being a few $100 million going to $100 billion, and that's the kind of thing that you want. And so looking for small companies, that's something that Chris Mayer said in his book, 100 Baggers as well. He's sort of moved on that, but I do think if it's under $1 billion or $2 billion, of course it's got a much better chance of growing to that 100-bagger or multi-bagger status, because it starts small and grows, but perhaps a bit more risk because they haven't really won. If you think about American Tower back when he bought it, they were in financial trouble, they had leverage, and they got out of that, they got through that. He could see that they were going to get through, or at least they weren't going to get bankrupt, but he didn't know that they were going to grow that big. He just didn't know. He said that. It was just so partly luck, but partly good foresight and just letting it run for years and years and years. He also asked what would cause him to sell, and he said if the three-legged stool, if one of those legs gets kicked out, gets broken, any one of those three legs, then that would be a cause to sell. But sometimes these things are temporary, so you have to be sure. He said they've made mistakes in selling when they shouldn't have. It's easier to do that. Remember when he said that the hardest thing is to hang on, and some of these 100 baggers have been up and down. If you think about Amazon, even over time, it's lost 90% of its value at one time. So only selling when you're sure that one of those things is not working, he says. Chuck Akre is legendary for finding these 100 baggers and multi-bagger stocks. I've made previous videos about 100 baggers and how to find them. I'm going to put a video up here for those on YouTube and in the description for those listening elsewhere if you're interested in that. And if you've got this far in the video, we're well over 1,000 subscribers on YouTube and on Spotify now across those video platforms. So think about subscribing and following if you like this kind of content and would like to see more.